by the central bank. So you might look at that and say, well, the more things they look at, the better, because why would you want to ignore some things? But the problem is you weaken your commitment to the exchange rate peg the more other things you're looking at, the more other goals you consider you have the freedom to pursue. So, I mean, the famous classical analogy is when Ulysses wanted to sail his ship past the island of the Sirens, right, he knew that when they sang in this alluring song, he would be so tempted if he was steering the boat when he heard this that he would steer over to their island and smash the boat on the rocks. Now, the thing I never understood as a student was, if everybody who heard this song smashed their boat on the rocks, how did the word get out? But that's what happens. But Ulysses had a clever solution to this. He wanted to hear the song, but he didn't want to smash on the rocks. What did he do? He had his crew tie him to the mast, right? So that's a constraint on his behavior. And the person who was steering the boat had to plug his ears with wax. Now, it was a little unfair to the crew members. They should have taken turns going back and forth, but anyway. Right, so he got to hear the song without getting smashed up on the rocks. So by constraining his own behavior, his own temptation to give in, to pursue something that wasn't in his long-run interest, he got better results. So that's the spirit of the restrictions on a currency board. Better long-run results by constraining short-run behavior. By giving people confidence that policy isn't going to change next month. But if the Central Bank of the Bahamas is looking at credit market conditions, and it is of the opinion that, well, this is a bad time to tighten credit, therefore we can't let an outflow of US dollar reserves bring down the local money supply, then they're pursuing a policy that's inconsistent with maintaining the peg in the long run. And if they let it go on long enough, then it results in a crisis. And in that crisis, right, where the peg is inconsistent with the inflation or with the price level they're supporting, they have to choose among some unhappy options. One option would be belatedly and rapidly and therefore painfully trying to deflate the economy, having a tight monetary policy. Secondly, suspending its own running its own reserves of dollars down below its statutory requirement. Third, and probably the most likely, tightening exchange controls, not letting people convert so that the US dollars can't run out. Or fourth, and this would be, I hope, the last resort, devaluing against the US dollar. But I understand that there are exchange controls, so that they have become less stringent in recent years. That's a healthy trend. But if they adopted a more strict pre-commitment on monetary policy, you could avoid exchange controls entirely. Most currency boards have not had any exchange controls associated with them. So let me suggest that there are basically 5 options for Bahamian monetary arrangements, and then we can evaluate them with basically 2 tests. So the main options are: continue the current system with a pegged exchange rate. Second, harden the peg, and I've been hinting pretty strongly that this seems like a good idea to me. But there are 2 ways to harden the peg. One would be to amend the central bank's constitution to basically convert it back into a currency board. But there's a way to harden it still further, so this is my third option. Privatize the issue of currency. There's no reason it should be a government monopoly to issue local currency notes that are redeemable or convertible for US dollars. Let commercial banks do it. Is that something that's ever been done? Well, that was the norm in the 19th century, that commercial banks issued the paper currency. But it's still happening today. That's the way the monetary system works in Scotland, in Northern Ireland, and in the case I already mentioned, Hong Kong. That issuing currency is not the government's job, it's the commercial banks. And really, having a banknote, a circulating claim on a commercial bank isn't much different from having a checking account claim. You can pay people with it. It's a liability of the bank. It may take a little longer. It may change hands a few times, but eventually it comes back to the bank for redemption, just like the check does when it's deposited in another bank. So, in my introduction, it was mentioned that I've been a student of free banking. that's the name they gave in the 19th century to this idea that they were defending what already existed, and that banks should continue to be free to issue redeemable currency, rather than that business being monopolized, which was an innovation when it happened, and handed over to a government-sanctioned monopolist. So that's three options. Fourth option, float the Bahamian dollar, just end any fixed exchange rate with the US dollar. And fifth, return to a gold or silver standard, or some kind of commodity standard. And that one, I'm sure, is not going to have a lot of political traction. It's the least plausible politically. And there's a good reason for it not to have much traction, at least in the immediate run. Even though gold and silver worked pretty well when they were worldwide monetary standards. So if there were a worldwide monetary standards, the Bahamas should join it, as it did in the past when it was part of the sterling zone, and sterling was a hard currency, was redeemable for gold. So if a gold standard begins to reemerge, my advice is to join it, but jumping the gun is probably not a good idea. I mean, one small country switching to the gold standard by itself is not going to convert the world to the gold standard. And now you've got a money linked to a metal which has been demonetized in the rest of the world. So you're not going to stabilize its purchasing power. It's going to continue to fluctuate as it does today, where people buy and sell it as an inflation hedge. Right? When they think inflation is coming, they buy gold, the price of gold goes up. You don't want your exchange rate bouncing around that much. So if the world is back on a gold standard, that doesn't happen. That didn't happen under the historical gold standard. It's because gold has been demonetized that it's become so volatile. So let's rule that one out. Let's move on to floating the Bahamas dollar. I think this is also not a wise option, and it's been recognized throughout the history of the Bahamas, right? There's always been a link to either sterling or the US dollar. And generally, floating is not recommended for a small economy that trades heavily with a larger neighbor. It's too important to facilitate trade and financial flows between the two countries. Or to put it in technical terms, the Bahamas alone is not an optimal currency area. Right? There's a body of doctrine in economics, Robert Mundell got a Nobel Prize for this, called optimum currency area theory, which thinks about the choice of a monetary standard as a matter of weighing the costs and benefits, the benefits of membership in a larger common currency area, and the most important benefits are lower transaction costs with your trading partners and lower risk in making cross-border investments that the profitability will be undone by a devaluation. And weighs that against the possible alleged foregone benefits of having an activist or Keynesian monetary policy to try to mitigate business cycles. And I say, half seriously alleged, because I don't think it's been very successful where it's been tried. I think the evidence is pretty good that activist monetary policy has caused bigger fluctuations rather than smaller ones. It's an argument Milton Friedman made 40, 50 years ago. I think he's basically right about that. So it's just a matter of weighing the benefits against the costs, and it suggests to me that the benefits of being a member of a larger currency area exceed the costs of not being able to let your central bank run a Keynesian monetary policy. Now, I should mention that I have some reservations about optimum currency analysis, namely that it tends to look at things from sort of the top down. So it kind of dates back to the Keynesian era and takes seriously the idea that activist monetary policy is a net benefit in terms of business cycle smoothing, or that devaluation in particular is a way to reprice your labor when it's become overpriced on the world market. But I think workers in their wage negotiations and unions negotiating on behalf of workers have figured out that when there's a devaluation, they need to raise their wage demands. So I don't think that actually works very well. I don't think it is a sort of secret way of cutting real wages. And it's true that Keynesian economics has made something of a comeback in this